Good afternoon and welcome to today's Premium Account Short Form Market Update. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals. I have 17 years of experience in the financial services industry and as a licensed securities and derivatives advisor. The format for today's presentation: a quick summary of the global macro outlook driving equity valuations. We look at our preferred buy and sells as we roll through the top 50 stocks and review price targets and valuations in line with the financial year 14 earnings expectations, and likewise the trends into financial year 15. The services that we provide are centred around providing a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We focus on effective ownership of stocks around ex-dividend dates with the intention of creating above average cash flow and still producing capital growth. The portfolio is managed under a strict investment mandate, therefore suitable for self-managed super funds, and all the assets remain in the client name at all time. If you'd like to know more about it, please contact myself, Leon Hine, info@Investor Signals. Moving straight into a graph today and looking at the US market, just to backtrack on sort of some of the trends into the back half of 2013. So the S&P 500 companies in the US grew roughly around 7 to 8% earnings during calendar year 13. What was interesting is it accelerated into the December quarter. So if you compare the December quarter in 2013 to the December quarter in 2012, it was actually the fastest earnings growth rate relative to the previous corresponding period, so roughly around 10% in the December quarter. As we move into the March quarter earnings that we're starting to see come through from the US at the moment, what is evident is that that acceleration is not there, albeit that analysts are still optimistic that financial year, or calendar year 14 I should say, should deliver around 8% earnings growth for the S&P 500. That puts the market on a forward earnings basis of around 16 times earnings, and I think in that environment the argument would be is that equities are fair value, and that feeds into our base case that more than likely we get consolidation over the next 3 months and maybe a further recovery into the back half of this year, which will largely be driven by an improving synchronized global GDP picture, and we're seeing the early signs of better data coming through from Europe at present, which are sort of helping to support that macro theme that we're centering equity portfolios around. A point of note, we've seen the Australian dollar strengthen. That's a function of two things: inflation rate slightly running ahead of where the RBA had anticipated it to be, therefore the prospect of further interest rate cuts are diminishing in Australia, and also a function of the weak US dollar. And one way of viewing that sort of weak US dollar picture is to take a look at the 30-year treasuries in the US. So this is a graph where we've seen, and I'll just bring that up on the, sorry, not the 30 years, I should say the 10-year treasuries in the US. So I've been following this one. I'd spoken in the past around about 3% for 10-year treasuries in the US is resistance, around 2.5% was support. The US treasuries have essentially bumped sideways at around this 2.7 level for the last number of months, and I think that's a reflection of some concern around the GDP growth in the US. Now, a lot of analysts are dismissing that as a function of the extreme cold weather conditions that occurred in the US over sort of that late December, January period and into parts of February, but we're certainly starting to see better data coming through from the US. As the Federal Reserve starts to ease back on their stimulus measures, there are expectations that into financial year 15 we'll probably start to see the first sign of interest rate increases in the US. In that environment, we'd expect over the next 6 months for these 10-year treasuries to continue to find support at or near this sort of 2.5 to sort of 2.8% range, but ultimately we'd be looking for this to trend a little bit higher. Obviously that has some implications for the housing market, so it's a fairly finely balanced picture in the US where consumer spending is improving, manufacturing is improving, but one of the real drivers of the recovery in the US economy is the strength in the housing market, and we'll just keep an eye on sort of how interest rates behave relative to that recovery in the US housing market in the months ahead. And then to our domestic market, the XJO trading the same, around 15 times forward earnings, just over a 4% dividend yield. Forward earnings growth expectation for our market is around 7%, and as we roll through the top 50 companies shortly, we'll look at those names that we think are likely to outperform and those that are likely to underperform. So on that note, looking at AGK, on current earnings, we still see the stock as reasonable value. We're buyers of it down here at around $15. As it gets closer to our target of around $16, we look to sell covered calls. At $16, the stock's compressing down to something less than a 4% dividend yield. We're looking for somewhere around 5 to maybe 8% earnings growth in AGK over the 12 months ahead. But I think this is a good defensive name, and we're happy accumulating it even at these levels with a view of collecting the call premium and collecting the dividend in that August-September period. The yield on the stock on a forward basis, if we look out into financial year 15, is creeping up to around 4.5%. So I think AGK is still okay value, but likely to consolidate at around that $16 price point. Asiana, we're not doing anything here at the moment, and just to put this into perspective, it's on a yield of around 2.5% at these levels, but they disappointed during earnings season. The market was looking for about 10% earnings growth. It came in flat, so a little bit of distrust, I suppose. From a valuation standpoint, however, down here at somewhere this 5.50, I think we'll look back and recognise it as support, so it is on the radar, and we're keeping a close eye on Asiano. Amcor we've been recent buyers of. I've been speaking about this in recent recordings. We're back down here at around this $10 level. I see that as support. The stock is still reasonably expensive. It's on about 15 times current earnings. It's on a 4.5% dividend yield, but I think that the company will deliver close to 10% earnings growth. If the Aussie dollar pushes too much higher, it starts to erode some of that currency benefit that Amcor's enjoyed in the last earnings season. Still, I think the underlying business is strong. The exposure into emerging markets should continue to see the stock find support at $10. We're selling calls up here at around $11 and collecting sort of that August-September dividend as well there in Amcor. AMP has been a bit of a recovery story. Our preference has been just to play sort of the Australian banking stocks rather than exposure to AMP, and an example of that is ANZ. So we hold ANZ in the internal account. We haven't sold covered calls on it on a broad basis, and we've enjoyed the most part of this rally. The banking stocks are likely to remain strong into the May dividend, and then we'll probably see a little bit of a rotation out of ANZ, NAB and Westpac back into CBA, but I think the banking stocks continue to make sense to have exposure to those names. Looking for around 5% earnings growth to put some yield numbers on it. Now ANZ's trading just above a 5, or roughly in line with a 5% dividend yield, so compressing down to low levels. So arguably maybe the market would need to see these banking stocks deliver something that beats expectations, something higher than sort of that 5% earnings growth to really support these compressing dividend yields. ASX, moving on to ASX, I think this is value down here. I thought the earnings result were reasonably good. From a yield perspective, the stock trades around 5% dividend yield. It does trade about 18 times current earnings, which is a little expensive, but I think the stock's value after the recent sell-off from sort of 38 down to 35. So for capital that's available, I think ASX is a good buy at the moment. AZJ, I like AZJ. It is expensive. The company should deliver. The market's looking for around 15% earnings growth. I think maybe 10%. We're probably pretty close to a range where the stock consolidates, but we own it at lower levels, and we've sold the calls at 5.25, and I think we continue to play AZJ on the basis that it consolidates over the next 6 months. BHP just came out with their production numbers, as has Woodside Petroleum, Rio, Fortescue, Oil Search, Santos, all in the last few days. BHP probably, I think, was the standout between, say, BHP, Rio and Fortescue as far as it slightly exceeding market expectations. I don't think it really changes the valuation picture substantially, though our view on BHP is the company's probably likely to continue to look at the divestment of non-core assets that could potentially produce up to $20 billion in sales. Now, I think we've seen Rio fail to get away their aluminium asset sale that they're looking at. Likewise with the diamonds, BHP's maybe have assets that are a little more appealing, but nevertheless it just goes to show that it's not an easy market to divest assets at a solid price. However, I think BHP's balance sheet's certainly in a better condition than that of Rio. Not that Rio's is a problem, but comparing the two, BHP's in a stronger position, and I think the probability of seeing BHP return capital to shareholders is greater than Rio. And then obviously if we were to get an environment over the next 12 months where BHP looks to divest some of its non-core assets, it might accelerate some of that capital return. The underlying business, if we look at port volumes for iron ore export in the March quarter out of Australia, they still remain strong. They were still at higher levels than the same time last year. So whilst there's a lot of negative headlines in the media around China, the reality is the volume of iron ore that's being exported is continuing to grow, and that's evident, and I guess that's reflected in the confidence that we're seeing in BHP and Rio and Fortescue continuing to reinvest in their existing mines and expanding that capacity. So the forward outlook, putting the negative headlines aside that often are exposed around the China story, I think the argument is that probably BHP still, rather than Rio, still makes a lot of sense. So to put some valuation numbers on BHP, it grew at around 15% last year. With the re-acceleration in iron ore prices, I think that probably diminishes a little bit across the next 6 to 12 months. I think if BHP can deliver flat earnings into financial year 15, it'll be a good outcome. That puts the stock at around 11 times earnings and a 4% dividend yield. So we own it at lower levels. We've been waiting for it to rally up to our target of around $39. And we're reselling those calls somewhere around $39 to $40 is our next target on BHP. I think the stock probably from May through till August, September should perform well as investors position around the prospect of the special dividends and capital returns into the back half of this year. So we continue to like BHP as an asset in portfolios. Brambles, likewise, I think its exposure in the international markets, about 85% of its earnings comes from Europe and the US. As Europe turns around, as consumer confidence builds, as discretionary spending continues to increase, Brambles will be a beneficiary of that. They've obviously spun off the recall assets some months ago, so we're seeing more efficient use of capital in the Brambles business. I think somewhere around 8% underlying earnings growth. It puts the stock on about a 3.5% dividend yield. We own it at lower levels. Anywhere up here at around sort of, I think if we were to, even for fresh money that's not in the stock at lower levels, it's still safe to buy Brambles at these levels, sell the covered call out into the back half of this year, collect the upcoming dividend in August, September, collect that call premium, and really trade the stock on the basis that it largely moves sideways. There's good cash flow there of 10 or 12% per annum from the dividend and the call premium, and there's a high probability that we'll get knocked out on the top end of that range on a call option there, which would deliver somewhere in excess of 20% capital return over a 12 months period. I won't spend time on CBA. I've covered all the banks in general, so the theme doesn't really change too much across the banks. So Coca-Cola, we've seen them downgrade earnings 15%. Now, that disappointed. The market thought the worst of the downgrades were behind Coca-Cola, and the market slowly started to price in a pickup in at least flat earnings as an outlook for Coca-Cola. The company came through and warned that the net 12 months ahead is not going to deliver flat. There's going to be a further 15% downgrade. Now, even in line with that 15% downgrade, if we were to assume that that's sort of the worst of the profit downgrades that the company's faced over the last 12 months, fair value for the stock's back up at around $10.50, which would put it back on roughly a 5.5% dividend yield. I think sort of once this initial selling's occurred over the next month or two, we should see the stock move back up to around 10.50. We take that as an opportunity to sell covered calls. I think going to the extent that we have exposure to Coca-Cola, it's going to require a little bit of patience, but if we can continue to get those call options away and collect the dividend, we're getting paid around 12% in cash flow while we wait for the recovery in the underlying share price. Computer share, so this is an interesting story. My view up here was it was a little bit too expensive for my liking, trading up at about 20 times earnings on a 2.5% dividend yield. I still am of that view. However, we're probably likely to get consolidation given the backdrop of a fairly stable equity market, and I think an ongoing interest in investors gaining exposure to US assets. In the US, we've recently seen sort of a lot of strength in the pharmaceutical section. I think that'll probably add to a little bit of support in CSL off this level. I think from a valuation standpoint, the stock trades up at around 22 times earnings. It's on a 1.5% dividend yield, so it's expensive, but the company's still buying back its shares and growing underlying earnings around 10%. So I think it's safe to say that it's a buy on a pullback here at 67 and looking for it to trade back up to around $74, $75. Crown, interesting one on a pullback. I think at around $16 it starts to look okay value again. I think in an environment where equity markets sort of remain reasonably buoyant, I think it could trade back up to around $18.50, but I think there's some concerns around the capital expenditure requirements of Crown should it sort of win a number of these projects that it's bidding for or looking at present. The Australian casino assets are not really delivering a lot in the way of earnings growth. The growth's clearly coming from Macau at present. To put some numbers on Crown, the stock trades at 20 times earnings, just over a 2% dividend yield, and for a forward earnings growth, the market's looking for somewhere around 10 to 12% over the next 12 months. Fortescue came through with their production numbers. They're pretty much in line. The company's achieved its objective of delivering 155 million tonnes per annum, and they're looking on a forward guidance to accelerate that further up to 166 million tonnes per annum. Again, our preference is BHP over any of the other commodity stocks. In the coming week, I'll confirm the exact date, but I think that we're probably getting pretty close. I think around the 8th of May is the delisting date from the Australian market for Fox. We'll continue to have a look at the options available as to whether we transfer that asset across to a US exposure or whether we simply just cut it. And if we wanted to keep US exposure, something like Computershare could be an alternative to switch Fox out of, but again we'll sort of assess that as we get through tomorrow's option expiry. Goodman Group within the property space, I think it's at the top end of its range as it compresses down to sort of below 4% dividend yield, or sort of, I think at or near 4% dividend yield. I think that was resistance. Always saw it as okay value down here at $4.50, but as it nears $5, it runs into resistance. It's one of the rare property groups, though, it should grow earnings around 7% per annum, so it does remain attractive on a 12 to 24 month view, even though it's a little expensive short term. GPT, we've been buyers of this off this 350 level. I continue to like GPT up here at around 390, though it starts to get a little expensive. IAG not doing there at present. And moving through to Lendlease, which is a name again that we own at lower levels. We've been buyers of this up here at around $13. I just think it starts to get a little bit hard to justify short term. The stock's compressing down to sort of 3% dividend yield, trading around 14, 15 times earnings, and there's not that much evidence of earnings growth right at the moment. The market's very optimistic that over the next 3 or 4 years, though, the macro environment for Lendlease to grow earnings at double digit is certainly improving, but I think at around $13 the stock starts to struggle, so we look to either take profit after owning at lower levels or get fairly aggressive with selling our covered calls over Lendlease. Going into Mirvac Group, so this is a name that we've owned at lower levels and we've taken profit up here at around 178, so we're looking at sort of some of the other property plays as our preferred exposure. Macquarie, I think the argument here is it's probably time to start to look to de-risk in Macquarie and lock in some profit. From a valuation standpoint, Macquarie trades at about 19 times earnings on about a 4.5% dividend yield. I think National Bank has further upside in line with our broad view across these banking stocks. NAB trades at around 5.5% dividend, slightly cheaper than the other banks at about 13 times earnings, and so continue to like NAB, and I think it makes sense to have exposure to that in the portfolios. Newcrest I've covered in detail over recent recordings. Origin at $15 I think starts to look a little bit expensive. The stock's on about a 3.5% dividend yield, 20 times earnings. From a forward outlook perspective, the market's looking for around 10% earnings growth into 2015. The real story, as I've been mentioning with Origin, is if we go out into the latter part of 2015, 2016, we start to see earnings pick up substantially, and I think in that environment the stock could trade back up to around $17, $18, but right at the moment over the next 6 months I think it's locked in this range at around $15, so we own it at lower levels and we're selling covered calls at or near that $15 price point. Oil Search, so they delivered a reasonable production number. It came in slightly ahead of consensus, and I think again in line with Origin, Oil Search should see a ramp up in revenues in sort of latter part of 2015 into 2016. Our preference short term has been is to have the oil exposure to Woodside Petroleum, but Oil Search is certainly on our radar into the back half of this year. Not doing they're in QBE at present. Rio, again, the production numbers came out. They were largely in line with expectations. The slight miss on the iron ore side was offset by a better number on copper production, but our preference again is BHP over Rio. So Stockland, as it comes into its June dividend, we continue to like Stocklands. The stock trades on around 6% dividend yield, looking for around 7% earnings growth. Continue to like the name, but trying to get those calls away at around the $4.10 level to complement that dividend yield with the call premium, getting the cash flow up to around 12%. Sonic, I think a good name, although it's just getting a little bit expensive, up at around 18 times earnings. It's back below a 4% dividend yield. To the extent that we own it at lower levels, we're trying to sell the 1850 covered calls. The company should grow forward earnings somewhere around 8% over the next 12 months. Santos production numbers probably disappointed a little bit, came in a little bit below expectation, but I think the story here with Santos is over the next 12 to 18 months we're going to see substantial acceleration in revenues, which will lead to an improving dividend yield. The stock trades about 2.5% yield at the moment. Go out 12 to 18 months, I think we'll see that yield start to kick up to around 4%, and I think in that environment the stock can re-rate and trade back up to around $16, $17, so we've been buyers of it on this recent pullback here. Suncorp, nothing there at present, nor in Sydney Airports. Transurban, we continue to like this name. The stock comes into paying its dividend in June. The underlying business just came out with their March traffic numbers. They came in slightly ahead of expectation. Revenue was strong. We're probably looking for dividend growth somewhere close to around 10% per annum over the next 2 to 3 years. And I think that whilst the stock's expensive short term, and our view is that it runs into resistance and moves sideways around this 725 level, I think as we get into the back half of the year, into that December dividend, I think the stock could trade back up towards around 750, so we continue to have exposure to Transurban. Telstra, we've been buyers of this off this $5 support level. The view here is we saw it rallying back up to 525 coming into the August dividend. We've been patient. We've picked it up at lower levels. As the stock trades higher, we'll eventually look to sell covered calls over Telstra. The stock trades at about 15 times earnings and about a 5.5% dividend yield, so still very attractive relative to government bonds, and the underlying business should still grow somewhere around 3 to 5%. Toll Holdings, after the recent sell-off that it had from a valuation standpoint, the stock got down to around 12 times earnings, which is pretty attractive relative to the rest of the market. Now, if we look at the recent earnings result, there wasn't a lot of underlying growth in Toll. Forward guidance is pretty flat, so it really is a matter of if if GDP holds up well, and I think we've got every reason to believe it will do, I think we're probably looking at the bottom end of a support level here in Toll. I think the stock could trade back up to our target of around 550, which would put the stock back up at about 14 times earnings and just under a 5% dividend yield. At that level, we'd look to sell the covered calls again around the 575 level, so driving around that 12% cash flow from the dividend and the call premium. And arguably at $6, we'd start to look to try to lock in sort of a sale price up at around that level. I think that would sort of cap the upside short term for Toll. Excuse me. Westpac Bank, certainly strong coming into the upcoming dividend. We own these banks at lower levels. We've sold the European covered calls. We'll collect the upcoming May dividend, and I think that just sort of feeds into our view that over the next 3 to 6 months, the more the likely outcome for the market is we get some consolidation coming up. WDC, we've been buyers of this off the lower levels here at around 10, looking for it to trade up towards $11. At $11, we'll sell the 1150 calls. I can't see WDC compressing much below that. That would put the stock back on a low 4% yield, and as we've seen in these property names, when they get down to sort of that lower end of that 4% range, they run into resistance at around 5.5%. They get bought back up again. So that's what we've seen in WDC. Some hedge funds and money managers have been running the numbers over the split between WDC and WRT, with the preference moving towards Westfield Retail Trust. We've probably seen in percentage terms a slight outperformance there in Westfield Retail Trust, but I think much of a muchness. I think the longer-term story with WDC and their focus on major capital centre shopping centres and sort of the divestment of their non-core assets, I think on a 3 to 5 year basis, WDC continues to be an attractive property exposure play. But at around $11, it should run into resistance, and we'll cap that with a covered call. Again, turning sort of a 5% dividend yield into around a 12% annualised cash flow there on WDC. Wesfarmers, so we're buyers of this off the 41.50 level. It's now getting up to a level where we look to sell the covered calls somewhere up at around $45. It's worth capping it out, and that's simply on the basis that at these levels the stock's trading at about 20 times earnings. It's trading on a low 4% dividend yield. The company on a forward basis should grow earnings at about 8%. The divestment of the insurance business is obviously helping to improve the balance sheet further. It'll be interesting to see what Wesfarmers does, whether they simply earmark that capital for further rollout of and growth in the coals business, or whether they look to maybe do something around the Australian chemical business with IPL or Orica. We'll just have to wait and see. But just from a pure forward earnings perspective and valuation at around $44, the stock starts to get a little expensive, and it's worth selling covered calls. Woolworths, now this just really surprises me. Woolworths, I thought at around $35 to $36 the stock was looking expensive again. At these levels now, the stock's up again 19 times earnings. 20 times earnings. It's trading on a low 3.5% dividend yield. So the stock's very expensive. Forward earnings growth probably likely to only be around 6-7%. The Masters hardware strategy seems to be gaining a little more support. However, the stock is expensive no matter which way you look at it at these levels, and for that reason I think we probably look to take profit. Where we do own it at lower levels, we've capped the covered call out, so we're really at the moment not participating in any upside much above sort of this $36 level. So these rise of the last 3 days we've missed out on, but obviously that capital's been rotated into Wesfarmers, and we've been benefiting from the rise in Wesfarmers. But we continue to watch Woolworths carefully, because any opportunity to buy back in on a pullback I think makes sense, but sort of chasing it through here is getting a bit hard to justify. And Woodside Petroleum, so this is one of our preferred resource exposures, have been BHP and Woodside. We've enjoyed the upside here in Woodside Petroleum. I think our target was always to see the stock up at around $40 plus the call premium up at around $41. Was trading when we bought it back at lower levels here on a 6.5% yield. That's now compressing back down to sort of the low 5% range. I think the stock starts to sort of track sideways. The strong share price performance, probably out of all the March quarter production numbers that we've seen in the resource stocks, Woodside was the most impressive. They had strong production numbers and they achieved strong prices largely as a result of the Pluto pricing contracts and the added volume that was coming through. So Woodside Petroleum continue to be bullish on this, but from a valuation standpoint probably starting to get into that top end of the valuation range. And Westfield Retail Trust, we own this from lower levels back here at sort of 294 and 295, up here at around 320. I think it's time to start looking at capping the upside. If we can get around 10 cents for those calls, is an effective exit price up here to around 330, and we'll collect the upcoming dividend in August. Westfield Retail underlying earnings growth probably not much more than around 3%, but again, a number of money managers are looking at shifting out of sort of WDC into Westfield Retail as the preference post the asset split from WDC. All right, and so that really wraps up for today. Just to conclude with a short-term look at our market again, global GDP trends continue to look promising. The recovery in Europe appears to continue to be gathering steam, and the early indication of March quarter earnings in the US, albeit a little slower in growth from a previous corresponding period comparison, the numbers certainly haven't disappointed as the market had worried about a number of weeks ago, and I think we're likely to see continued strengthening in the US economy, and if we can start to see Europe contribute, that whole global picture and the probability of getting a more synchronized global GDP growth story that feeds into top-line revenue growth that goes on to support equity valuations again in the back half of this year and into 2015, I think becomes a fairly probable scenario. So thank you for listening in, and I look forward to speaking again next week.